What's going on, guys? Welcome back to another video. In this video, I've got another incredibly important AMC update to bring all of you this afternoon. So what we're going to be talking about in this video is the option chain going into the end of this week. There is a very important level that we are looking at that could maybe bring some more buying volume back into the market and could potentially drive the share price of AMC even higher. We have a very interesting Ortex update to go over as well. And we have an interesting situation going on with NSCC 002. When is it actually effective? Is it today? Is it tomorrow? When is it actually legally enforceable? And we're going to cover all of the information that we have at the current time on when we could start to see the results of this new proposed rule implementation. And we also have the massive collateral crisis going on with all of the institutions, the big banks, the investment firms right now. It is getting a lot worse, and this actually is a very good news for us as retail investors in a short squeeze play such as AMC. But again, nothing I say in these videos is financial advice. These are for educational and entertainment purposes only. And if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And the more people that we have learning about accurate and up-to-date information on AMC, the stronger our community becomes. And if you would like to earn those 2 free stocks with Webull, valued up to $1,850, make sure you check out that link down below in my description. So when we're looking at the price action of AMC today, we did see a brief rip up over $60 a share to $61.10 this morning, and then we were knocked back down. We saw another attempt at 60 here, again knocked down. We are seeing this happen throughout the day, and I do believe that there is a specific reason as to why a lot of these institutions and the people that can make these big trades that could actually move the share price of AMC do not want the share price going over 60. So when we take a look at the option chain, we can see that there is a decently high open interest on this $60 strike going into the end of this week. 28,220 contracts, and the volume on these contracts today, 38,000 contracts were traded. Now, I do think that the open interest, which is the amount of contracts that people are holding in their brokerage accounts, is going to continuously increase going over the next couple of days that we have left in this trading week. And if we can close above 60, this could potentially provide for some more buying pressure from these institutions that need to delta hedge these call options. Now, I do not think it is going to be a massive gamma squeeze, but I do think that this extra buying volume could help us out. Now, when we come over to Ortex, there is something very interesting happening. Now, if you guys remember what I talked about in yesterday's video about the utilization, there was something a little bit strange about the numbers that we are seeing. So we did see a net borrow against for AMC shares, the loaning out of shares to actually be shorted yesterday. And we are also seeing something similar happen today. But the utilization is actually going down. Now, the utilization, the definition of it is the amount of shares that institutions are willing to lend versus the amount of shares that have been lent out already. So there is something a little bit fishy going on here. But if you come over to Matt Core's Twitter, he actually put out a statement on this, and he said that the utilization dropped because the total size of loanable shares has increased. Nothing to worry about. They are digging a deeper hole. Now, I have not been able to personally verify this, but I have seen in the past Matt actually have some contact with the people at Ortex, so maybe that was how he was able to determine this. Something else that is very interesting, however, is that there's a lot of these new prime brokerages that are now shutting down the ability to short shares of AMC. Now, if you don't have the ability to short AMC at one of these different brokerages, then the amount of shares that institutions are willing to lend would most likely decrease, and the utilization would jump up to almost 100%. So there are a couple of explanations for why we could see the amount of shares that institutions are willing to lend actually increase. We could see maybe the larger investment institutions such as BlackRock, Vanguard potentially be loaning out shares. I highly doubt it. Or we could see the smaller investment institutions that not a lot of people are using at the current time, taking full advantage of all of these new prime brokerages that are now turning off the ability to short AMC, and they now want their business. Now, we really need to talk about NSCC 002. So this is what I like to call the automatic margin call rule. It changes the calculation of supplemental liquidity deposits from being only calculated once a month around the time of the monthly options expiration dates to every single day. This is a very good rule, in my opinion, for us. And it could really put a lot of pressure on a lot of these institutions who are massively over leveraged at the current time. But again, I do not want to get everybody's hopes up for one specific rule change to trigger the MOAS. If you remember last video, I gave 3 different scenarios of how this rule could actually affect us: the best case, mid case, and worst case scenario. The best case was essentially when this proposed rule change gets approved, which it has been. As we can see here, it has been approved on an accelerated basis. We can see the supplemental liquidity deposit calculations really come into play. It puts a lot of pressure on these institutions. The collateral crisis that they are in gets even worse, and they may start to cover some of their position. That is the best case scenario. The mid case scenario is that a lot of these institutions still may be able to hide some of their positions, or it takes a long time for this actual rule to kick into effect for us to actually see the effects. The worst case scenario is that, well, maybe it won't do a whole lot. I do not think that that is the most likely case, but it is always a possibility. So we know here that the proposed rule change has been approved. Now, when we come over here, we can also see that the effective date, the date that the proposed rule change is going to be effective, is going to be Wednesday, June 23rd. That is today. So the rule is actually effective at the current time, but it has not yet been posted to the Federal Register at the current time that I am recording. So it is possible that when you guys are watching this, it is already up, but it is scheduled to be published on June 24th. Now, why and how does this actually affect us at all? And this brings us over to another one of Kringle Kitten's tweets, which if you guys are not already following him on Twitter, you guys definitely should. He is a very smart individual. So as we can see here, however, at the level of the DTCC, they say that the effectiveness of this rule is active as of today. What does this mean? It means the DTCC can act upon that rule as of today, but it's not exactly legally enforceable until tomorrow. So we are in this kind of in-between phase until tomorrow when we are going to see this rule actually be legally enforceable. But either way, this rule change is coming in our near future, and I do believe that this is going to actually have an effect on the playing field that we have in this market right now with the over-leveraging, and it's going to hold some of these institutions accountable, in my opinion, and it is going to try and make things more fair. Now, let's get into this collateral crisis. So we all know that there is a very significant collateral crisis going on at the current time in our financial markets. Collateral is a very hot commodity to come by, especially if these institutions want to make the levered trades that they need to in order to generate these high returns. Now, we can see here that this morning, this is a small value exercise for operational readiness testing. And we can see that the amount was about $7.7 million in reverse repos with about 77 counterparties. Now, this did get me pretty excited that they were going to be winding down the reverse repo program because essentially what the reverse repo program is when the banks have so much cash that they have at the current time, it actually becomes a liability on their balance sheet because they do have to pay interest on that cash. But if they can convert it into treasuries, they can actually generate a very small yield and then also use those treasuries as collateral because they are a more safe form of collateral because they are essentially a risk-free investment than cash. So what I do believe is happening now with this small value exercise for operational readiness testing, the Fed is performing a stress test at the current time. So I do think that this is part of their stress testing members, and they are seeing what could possibly happen in their models if they were to wind down the reverse repos, which they need to do in the near future. And here is why. We can see that the actual number of reverse repos that were submitted today was $813 billion with 73 accepted counterparties. This shows us that the collateral crisis right now is just getting worse. All of these institutions need to get their hands on these treasuries in order to post them up as collateral and generate that very small return. And we know that the margin debt in the United States right now is at a very significant level. It is at about $850 billion. And in 2008, the last global financial crisis, that margin debt amount was only at about $400 billion. Now, who are some of these members of the actual reverse repo program, and why is this even important? So when we come over here, we can see that Bank of America, Barclays, Citi, Goldman Sachs, JP Morgan, Morgan Stanley, Royal Bank of Canada, Wells Fargo, and we can come down a little bit further, BlackRock, BNY Mellon, Charles Schwab, Deutsche Investment Management, Fidelity. There are a lot of very, very popular investment firms that are listed here that are getting this collateral from the Fed. Now, eventually, they are going to have to pay this back, and they are not going to be able to get this collateral from the Fed anymore. That is when I think we are going to see some stuff really start to unfold. And when you combine this with the implementation and effectiveness of NSCC 002, it's kind of a perfect storm. And I do not believe that there is a coincidence between the Fed really jacking up these reverse repo numbers and doing this small value exercise for operational readiness testing. I think it is all connected at the current time and something that we need to keep our eyes on. Now, in addition to this, I think we all know that yesterday we did see White Square Capital close some of its doors in its main fund. And this was due to the actual actions that they were engaging in back in January. So you guys all know by now that my two biggest indicators for when we are getting close to the squeeze, in the squeeze, or near the top of the squeeze is going to be hedge fund bankruptcies, and overall market sell-off. Now, I have not really been able to determine for sure yet what is going to come first, the news of hedge fund bankruptcies or market-wide sell-off. But at this time, I think I am leaning more towards looking for overall market sell-offs versus the actual collapse of some of these funds. Because if you look at this, these losses that White Square was taking were happening back in January, and it's going to take them a significant amount of time, in my opinion, to wind down the fund. They can't just liquidate all at once. So I do believe that if once we see these mass liquidations of a lot of different funds starting to actually wind down and we do see those sell-offs, I think that is going to be the key indicator to look out for when we are going to receive these tendies and enter the mother of all short squeezes. So that is going to conclude this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day, and I'll see you guys in the next video.